Over the past 2 decades, the Greek bond market has moved from sovereign crisis and extreme market stress towards stabilization and improving investor confidence. But how did Greek government bonds evolve through the periods of uncertainty, and how does Greece compare today with major international bond markets? In this report, we examine the historical evolution of Greek government bond yields through sovereign spreads, yield curve dynamics, risk-adjusted performance, and inflation expectations. My name is Panagiotis Moutsiopoulos. I am a graduate of the Department of Accounting and Finance at the University of the Peloponnese, an affiliate member of the UOP Finance and Investments Club, and an incoming master student in wealth management at the University of Luxembourg. Before we begin, here's a brief overview of the structure of the presentation. We will first discuss the key findings of this year's report and the broader global bond market environment. We will then move into the analysis of Greek government bond yields, monthly yield dynamics, and cross-country sovereign bond comparisons. After that, we will examine sovereign spreads, yield curve modeling, fixed income performance, and inflation expectations. Finally, we will conclude with the methodology, limitations, and broader implications of the analysis. Bond markets have become increasingly important for understanding inflation, interest rates, economic expectations, and sovereign risk. This report focuses on Greek government bonds and examines how the market evolved from one of the most volatile sovereign debt environments in Europe into a significantly more stable fixed income market. The report reveals several important findings regarding the evolution of the Greek sovereign bond market. One of the most significant observations is a structural transformation of the market over the past 2 decades. During the sovereign debt crisis, Greek government bonds experienced extreme volatility and historically high yields, reflecting elevated default risk and severe market uncertainty. However, over the last decade, conditions improved considerably. Yields stabilized, sovereign spreads narrowed, and the market gradually returned to more normal levels. The analysis also highlights increasing convergence between global bond markets, although differences in sovereign risk profiles still remain. Another important observation is the consistency in monthly yield dynamics across most maturities, with major deviations appearing mainly during periods of financial stress. Moreover, sovereign spreads between Greece and Germany compare significantly over time, indicating improving market confidence and stronger fiscal credibility. Another important finding is that the Greek yield curve gradually normalized and adopted a more conventional upward sloping structure, reflecting lower systemic risk and improving macroeconomic conditions. The report also examines inflation expectations, particularly in the United States, where break-even inflation rates remain elevated but relatively anchored over the long term. Finally, the analysis of fixed income performance suggests that the Greek government bonds generally outperformed Greek corporate bonds over the past decade, although risk-adjusted performance varied depending on market volatility and broader market conditions. We now move into the first section of the presentation, which focuses on the global bond market environment. The global bond market has experienced strong growth in recent years, reaching approximately $120 trillion in 2025 and expected to expand further over the next decade. This growth is supported by several structural factors, including rising institutional demand for fixed income, continued government and corporate bond issuance, and the expansion of ESG and emerging market debt. At the same time, technological improvements and broader market participation continue strengthening the global fixed income market. This slide illustrates the structure and geographic composition of the global bond market. The first chart shows that the market is relatively balanced between public and private issuers. The second chart focuses on regional distribution. North America represents the single largest fixed income market globally, accounting for roughly 39% of total market value. However, the majority of the market remains diversified across Europe, Asia, and other regions. We now turn to one of the core parts of the report, the evolution of Greek government bond yields. This chart illustrates the evolution of Greek government bond yields across multiple maturities. The most notable feature is the sharp surge in yields during the sovereign debt crisis between 2010 and 2012, particularly in shorter maturities, as markets priced severe default risk and financial instability. In the years that followed, yields gradually declined as investors' confidence improved and economic conditions stabilized. More recently, yields have remained relatively lower, although they increased modestly along the broader global rise in interest rates. Overall, the chart highlights Greece's transition from extreme sovereign stress toward a more stable and normalized bond market environment. Average Greek government bond yields also show how different maturities reacted across distinct market periods. Short-term bonds displayed the largest fluctuations, reflecting their greater sensitivity to sovereign risk and refinancing concerns during the crisis years. Over time, yield levels gradually converged and became more compressed across the curve, suggesting lower perceived default risk. Median yields provide a clearer view of long-term bond market behavior by reducing the impact of extreme crisis period observations. The data shows that yields gradually became more stable across maturities over time, despite temporary periods of elevated sovereign risk. Longer maturities continue to incorporate higher risk premiums, although overall dispersion declined significantly after the crisis years. From 2015 onward, median yields moved toward lower and more consistent levels, supporting the broader trend of market stabilization. Yield volatility increased sharply during the sovereign debt crisis, especially in shorter maturities, while after 2015, volatility declined substantially across the yield curve as market conditions gradually stabilized. Risk dynamics can also be examined through standard deviation and value at risk, or VAR, which reveal a similar pattern to the previous charts. During the crisis years, VAR levels were significantly higher, reflecting elevated downside risk, whereas after 2015, risk levels gradually stabilized across maturities as market conditions improved. The yield-to-risk ratio measures how much return investors receive relative to the level of risk taken. During the crisis years, risk-adjusted performance remained weak because high volatility offset the benefit of elevated yields. As market conditions stabilized and volatility declined, the ratio improved considerably across maturities. By the 2020 to 2025 period, risk-adjusted performance reached its strongest levels, particularly for longer-term bonds. We now move from the long-term evolution of Greek bond yields to a closer look at monthly yield dynamics. The monthly behavior of 3-month Greek government bond yields appears relatively stable compared to longer maturities. Average and median yields remain close to each other across most months, suggesting limited volatility in short-term borrowing costs. Although temporary spikes appear in some periods, the overall pattern indicates that short-term Greek bond yields became increasingly stable over time. This slide focuses on the 2-year maturity segment. Here, we observe a much larger divergence between average and median yields compared to the 3-month maturity. While median yields remained relatively stable under normal market conditions, average yields increased sharply during the sovereign debt crisis. Although conditions normalized significantly in recent years, the 2-year segment remained highly sensitive to changes in investor confidence. The 10-year maturity segment appears more stable compared to short-term bonds. Median yields remained relatively consistent throughout the year, reflecting more anchored long-term expectations. Although average yields were slightly higher due to past crisis periods, the gap between average and median values remained relatively limited. This suggests lower volatility and a more balanced pricing of long-term sovereign risk. The 30-year maturity segment also appears relatively stable despite incorporating higher long-term risk premiums. Median yields remained fairly consistent throughout the year, while average yields stayed somewhat higher due to the lasting effects of past periods of uncertainty. Here we can see that the 3-month segment remained broadly stable throughout the year with limited volatility across most months. However, temporary spikes in volatility appeared toward the end of the year, particularly in November and December, reducing risk-adjusted performance despite slightly higher yields. Volatility plays a much larger role in the 2-year maturity segment. Although yields remained elevated across many months, volatility was also significantly higher, reducing the consistency of risk-adjusted performance. The yield-to-risk ratio fluctuated sharply throughout the year, notably during periods of market stress, highlighting the sensitivity of medium-term bonds to changes in sovereign risk. The 10-year maturity segment appears more balanced and stable compared to short-term bonds. Yields remained largely consistent throughout the year, while volatility stayed more contained than in the 2-year segment. As a result, risk-adjusted performance remained more stable, indicating a more balanced relationship between return and risk in the long-term segment of the yield curve. The 30-year maturity segment reflects the long end of the Greek sovereign yield curve. Although long-term yields remained generally stable throughout the year, volatility still fluctuated moderately across certain periods. As a result, risk-adjusted performance varied, depending on the balance between yield and market uncertainty. Having examined the evolution of the Greek bond market, we now broaden the analysis to see how Greece compares with major international sovereign bond markets. This chart compares 3-month government bond yields across Greece, Italy, Germany, and the United States. The divergence during the European sovereign debt crisis is immediately visible, with Greece experiencing a dramatic spike in short-term yields, while Germany and the US remained relatively stable. From 2015 onward, yields gradually converged as market conditions improved and investor confidence returned. After 2022, all countries moved higher together as central banks raised interest rates in response to inflation pressures, although Greece continued to trade with a modest risk premium. The lower chart shows that risk-adjusted performance also became more stable in recent years as volatility declined across markets. This chart compares short-term government bond dynamics across the United Kingdom, Switzerland, and Japan. The differences in monetary policy paths are clearly visible. Switzerland and Japan maintained extremely low yields for long periods, while the United Kingdom experienced a much sharper increase after 2022 due to stronger inflation pressures and tighter monetary policy. The lower chart shows that the UK generally achieved stronger risk-adjusted performance, particularly in recent years, as higher yields were not matched by equally large increases in volatility. This chart focuses on 2-year government bond yields across Greece, Italy, and the US. The most striking feature is Greece's dramatic yield spike during the sovereign debt crisis, while Germany and the US remained generally stable. After 2015, yields gradually normalized and spreads compressed as fiscal conditions improved and investor confidence returned. The lower chart shows that risk-adjusted performance was highly unstable during the crisis years, particularly in Greece, but gradually became more balanced over time. This chart compares 2-year government bond dynamics across the UK, Switzerland, and Japan. The UK experienced the sharpest increase in yields after 2022 due to higher inflation and aggressive rate hikes, while Switzerland adjusted more gradually and Japan remained near very low yield levels. The lower chart shows that risk-adjusted performance improved in recent years, especially in the UK. This chart further confirms the patterns observed in previous maturities. Greece experienced a sharp yield spike during the sovereign debt crisis, while Germany and the US remained comparatively stable. Risk-adjusted performance also became more stable in recent years as volatility gradually declined. Similar patterns can also be observed in the 10-year maturity segment. The UK maintained higher yields while Switzerland showed more moderate movements and Japan maintained exceptionally low yields. Risk-adjusted performance improved more noticeably in the UK. The Greek sovereign debt crisis remains clearly visible in the 30-year segment of the yield curve as well, with Greece diverging sharply from other markets. Over time, long-term yields became more aligned across countries, while risk-adjusted performance became more consistent. We now turn to sovereign bond spreads and the differences in borrowing costs across countries. This chart focuses on the spread between Greek and German 3-month government bond yields. The sharp widening during the sovereign debt crisis reflects the severe market stress and fragmentation that existed within European bond markets at the time. After 2015, the spread gradually narrowed as market conditions stabilized and investor confidence improved. In recent years, spreads remained relatively low, indicating a much more normalized short-term funding environment for Greece. This chart examines the spread between Greek and German 2-year government bond yields. The dramatic widening during the sovereign debt crisis reflects the intense market stress and default concerns surrounding Greece at the time. As financial conditions gradually stabilized, the spread narrowed significantly and moved toward much lower levels, indicating reduced sovereign risk within the Eurozone. The 10-year spread became one of the clearest indicators of sovereign stress during the European debt crisis, as investors demanded a substantial premium to hold Greek debt relative to German bonds, following a similar pattern to previous maturities. The 30-year spread reflects how markets priced Greece's long-term sovereign risk during and after the debt crisis. At the peak of the crisis, spreads widened dramatically as investors demanded significantly higher compensation for holding long-duration Greek debt. More recently, the long end of the curve appears considerably more stable, reflecting stronger confidence in Greece's long-term fiscal outlook. We now move into yield curve modeling and the structural evolution of the Greek government bond market across different maturities. This chart illustrates how the Greek yield curve evolved across different phases of the sovereign debt crisis and the subsequent recovery. In 2010, the curve was highly distorted and partially inverted, reflecting severe market stress and elevated short-term default risk. By 2015, conditions had started to stabilize, although yields remained elevated across maturities. In 2020, yields moved significantly lower due to accommodative monetary policy and ECB support. By 2025, the curve adopted a much more conventional upward sloping structure, indicating improved market confidence and a more normalized bond market environment. This chart presents a smooth representation of the Greek yield curve using cubic spline interpolation. The earlier curves appear steep and irregular, reflecting the instability and market distortions over the sovereign debt crisis period. Over time, the curves gradually become smoother and more stable as sovereign risk declined. The Nelson-Siegel-Svensson model confirms the broader pattern observed in the previous yield curves, showing the transition from crisis-driven distortions toward a more normalized and stable bond market environment. Chapter 7 focuses on fixed income performance and how Greek bond investments behave through periods of crisis, recovery, and market stabilization. The Hellenic Corporate Bond Index and the Piraeus Hellenic Bond Fund remained relatively stable between 2016 and 2020 as market conditions gradually improved. A sharp decline appears during 2020 following the COVID-19 shock before markets recover strongly in 2021 with the support of central banks. Another weaker period emerges in 2022 due to rising interest rates and inflation pressures, although conditions gradually stabilize again in the following years. This comparison illustrates the difference between the Hellenic Corporate Bond Index and the Piraeus Hellenic Bond Fund between 2016 and 2024. While a hypothetical 100 investment in the index remained broadly unchanged over the period, the same investment in the fund grew substantially. The actively managed bond fund displayed higher volatility than the index, reflecting greater exposure to market fluctuations. However, volatility declined across both portfolios in recent years as market conditions gradually stabilized. The yield-to-risk ratio highlights a clear difference between passive market exposure and active bond management. Over the full 2016 to 2024 period, the actively managed Piraeus Hellenic Bond Fund achieved substantially stronger risk-adjusted performance than the corporate bond index. However, during the more recent 2020 to 2024 period, risk-adjusted returns weakened across both portfolios, as rising interest rates negatively affected bond prices. Chapter 9 focuses on inflation expectations as implied by bond markets and how investors price future inflation through fixed income securities. This chart examines US 10-year break-even inflation and how inflation expectations reacted to major economic shocks over time. During periods such as the 2008 financial crisis and the 2020 pandemic shock, inflation expectations declined sharply as markets priced weaker economic activity and higher uncertainty. From 2021 onward, break-even inflation increased significantly due to rising inflation pressures and strong post-pandemic demand. Although inflation expectations fluctuated considerably across different periods, they remained relatively anchored over the long term around the 2% range. This section outlines the main methodology and limitations of the analysis. The report uses government bond yield data across multiple maturities, primarily based on monthly observations from publicly available market sources. To improve consistency and comparability, common time periods and standardized calculations were used throughout the analysis. The study also applies yield curve estimation techniques such as cubic spline interpolation and the Nelson-Siegel-Svensson model, although there remain theoretical approximations of market conditions. Additional limitations also apply to some of the estimation models and comparative analysis used throughout the report. Certain periods contained limited maturity observations, making yield curve estimation more difficult and reducing model stability in some cases. In addition, break-even inflation reflects market-implied expectations rather than direct inflation forecasts and may also incorporate risk premium and market sentiment. Finally, comparisons between Greek government and corporate bond performance should be interpreted carefully, since actively managed portfolios are influenced by portfolio allocation, security selection, and investment strategy decisions, which may change over time and do not guarantee future returns. This analysis will also be posted on the YouTube channel of the University of the Peloponnese Finance and Investments Club. So if you're interested in finance and investing, feel free to check it out there as well, along with more videos and analysis that will be posted on the channel in the future. This presentation was prepared exclusively for informational purposes and does not constitute investment advice. Thank you for watching. We hope this report provided useful insights into the evolution of the Greek bond market and broader fixed income dynamics over time. And if you enjoyed this presentation, feel free to support both this channel and the UOP Finance and Investments Club for more research and market analysis. The social media links for both will be available in the description below, and feel free to contact us for any additional information, questions, suggestions, or potential collaborations. Thank you.